premium you pay to get the type of return in the stock market is the ability to lose money at any time.
Another point you made was you said a lot of people don't take enough risk in retirement. So let's talk a little bit about that. What do you mean by that, Dave?
I mean, this is probably the one area that I agree with Dave Ramsey. I mean, I don't get me wrong. I love Dave Ramsey. I think that Dave Ramsey, if you're making 50 but spending 60, Dave Ramsey is going to do he's going to do a world of good for you. He's going to set you on the road to financial independence. But Dave Ramsey has long said that you should keep your money 100% invested in the stock market for your entire retirement. Why? Because the S&P 500 has historically returned between 11 and 12%. Bonds are erratic, they're volatile, you're going to get much lower amounts. In some years, you may even lose money. So why do bonds when you can just let it rip in the stock market, right? So that's obviously a pretty irresponsible approach because it doesn't account for investor psychology in retirement, and people need their money to be there when they need it. And if the market takes a tumble because you're 100% invested in stocks in the first decade of retirement, the numbers on this are breathtaking. You take an 8% withdrawal rate on 100% stocks, like Dave Ramsey recommends, you're going to run out of money, after 20 years, about 63% of the time. You're going to run out of money in advance of life expectancy. It's not even a coin flip, 2 out of 3 times. I agree with principle. I agree in principle with Dave Ramsey that you should be taking a lot of risk because you need your money to last a full 30 years. But I think that that the solution is not to eliminate a bond-like instrument. Okay, I think you could eliminate bonds in theory, and one way to do that is to simply reach into your portfolio, remove the bonds, replace it with an annuity, and that will actually increase your return. It'll lower your risk. It'll lower the standard deviation of your entire portfolio, and you'll experience a better outcome over time. And so the answer is not to eliminate bonds. The answer is to eliminate bonds so long as you replace it with something that does the work that bonds set out to do, but in a more efficient and effective way.
Yeah, it's interesting because I often talk about when we look at historical returns, it's so misleading, and that's why there's always disclaimers about historical returns. Don't equal future returns, but it depends on your time in history, right? Because if your withdrawal, even if not necessarily losses, but if you look at 2000 and 2010, if you're just looking at the S&P 500, we had zero growth. That was the lost decade, right? Start to finish, it was a zero return. If you're drawing 4% a year, 8% a year, or 4% adjusted for inflation, you've got a loss every single year, and that's going to be escalated. Not to mention, it wasn't a straight line. So you're going to have monthly withdrawals or whatever your periodic withdrawals were, and some of them are going to be in very low positions that can never recover. So it really doesn't matter to you that the S&P 500 returned 12% a year since 1920 or whatever the number is. It depends on if you're retiring in 2025 and you're going to live another 30 years. What's the return of the S&P 500 going to be? We don't know. But there's going to be a lot of fluctuation there, and your average person can't withstand it. So it's just you definitely need a more robust strategy, and a simple way is exactly what you said: just eliminate the risk altogether of the bond portfolio. Because if you look in, was it 2022? I think we are now, right? So stock market was down about a little over 10%, and the bond market, depending on what bonds you're in, we're down anywhere from 8 to 11%. So you were down on both sides of that. And so just eliminating that risk has big advantages to folks. But again, we go a little much more in depth and make it very difficult for ourselves. Where most people have 5 different segments, multiple accounts, just set up to draw out specifically. But there's some core principles, and the first one is you've got to protect yourself against those deep down drawdowns, and we replicate the Great Recession in our financial planning strategies, and where you see 30+% drawdown. The market can drop 30% at any given time. We don't know. It could be tomorrow. we just don't know. So you have to be prepared for it.
I've read an excellent book by Morgan Housel called The Psychology of Money. And he says, look, the premium you pay to get the type of return in the stock market is the ability to lose money at any time. He's like, you could pay $100 to go to Disney World and it could rain all day. Mm-hmm. Guess what? The upside is the fun that you have at Disney World. The downside is you could go and it could rain all day, right? So that's stock market investing for you. The upside is that you could earn 30% in a year. But the downside is that you could lose up to half of your money like we did at a certain point in 2007, 2008. I mean, so the thing about the stock market is it's historically, if history serves as a model of past prologue, it's a permanent upward trend punctuated by, periodic downward turns, periodic bear markets. And that's why, I've been talking about my upcoming book. I got a whole chapter on explaining why I believe the stock market is the single greatest engine for wealth creation the world has ever seen. And I think that when we forego the stock market in retirement to continue to do the heavy lifting for us and generating wealth, we do it at our own peril. And so I'm a huge fan of taking a lot of risk in the stock market, so long as you have these other financial tools in place that give you a permission slip to take that type of risk.
Yeah, and that's and going back to my conversation with our newest planner today, we talked about this happened to be a younger person, and we were talking about an annuity allocation, and he said, well, I know this person has wanted maybe to do some speculation and whatnot, and we typically carve out about a third of a portfolio to go into something that's principal protected. So, and I said, well, that's great. That gives him more ability to take those risks because he's got this, again, that foundation where if he invested on it all in something very, very speculative on his own, then and that loses altogether. He didn't lose it all, right? And I don't think he's going to do that, by the way, but it gives your average person, even if it's not this individual, the ability to reach a little bit more when their portfolio is protected. Because like you said, you've taken away that downside risk. When you plug that tool into your portfolio, it allows you to reach a little bit more for what you don't need today.